All right, let's talk about mortgage, interest, and term. What is a mortgage? A mortgage is an agreement between you and a lender that gives the lender the right to take your property if you fail to repay the money you've borrowed plus interest. Mortgage loans are used to buy a home or to borrow money against the value of a home you already own. So, as you can see, a mortgage is a valuable and a dominant part of real estate. Now, overall, if a person wants a home, there's a house in place, there's my beautiful house. Well, overall, if Tim here wants to buy this home, and this home is worth or is selling for $100,000. Well, Tim only has $20,000. So how does Tim afford to buy the $100,000 house? Well, Tim goes to a bank, and that bank says, Tim, I will lend you 80% of the purchase price for you to buy this home. And Tim's like, okay. And he does the math. And he's like, oh, I can actually afford this now because I have $20,000 and that's 20%. So I'm going to have to pay the bank 20% down or down payment. And in return, the bank is going to give me 80% to go towards the $100,000 or the purchase price of this home. And what that does is it makes sure that the bank has equity. So equity is the amount difference from the debt of the property. So for instance, if Tim went and borrowed that $20,000 against the home, and then the bank lent him 80% on the home, so $80,000, and the home's only worth $100,000, that would be 0% equity, which is bad. We want the home to be worth more than the debt that's currently on the home. Any lender, it doesn't matter if it's a bank or an individual, is going to want some type of security, because if the market goes down, well, what is their protection? They don't have any. It's always the asset, and the asset is the home. So for instance, if we look at this, we've got our mortgage, and our mortgage is going to be roughly 80% of the loan to value, LTV. Now this 80% during certain times in the market can easily become 75, 70, and even 65% LTV. Overall though, the lender will lend this amount of money and knowing that the purchaser is going to bring the remaining amount. So if it's 80%, the purchaser over here will bring 20. If it's 75%, he'll bring 25. If it's 70, he'll bring 30, then 35. Now this over here is the equity that the purchaser is actually paying for. And that makes the bank in a good position to foreclose, because since the purchaser has already given the bank these funds, that means that if the bank was ever to get this house, then they would be able to sell it and recoup all of their money, because they would definitely be able to sell it for 100% of the property, or even 90% of the property, or even 80% of the property value, and still be able to get all their money back. I hope this makes sense, because again, the purchaser over here, which is Tim, he pays the down payment and he receives a loan for a certain amount of percentage on the LTV, loan to value. And now this loan is the amount lent, and we'll say that's $80,000. Again, with this loan there becomes term. So what is the interest rate? Well, let's just say the interest rate is 6%. Well, what's the time period, which would be the term? We'll say it's 30 years, which is very normal. Normally, typically on residential property, you're looking at 30, 20, and 15 year terms. So this is your term, this is your interest, and this is your amount, okay? Together, it creates the terms or mortgage. And then there's a mortgage statement, which has all this information included on it, which is a piece of paper, and it will say your current balance is, your current interest rate is, your year is, and it will have all this information on here. This is also called debt because this amount is owed. Now, this right here, again, is equity. So you got debt and you got equity. Now, equity is the good side of real estate investment, and debt is the bad side of real estate investment. But over time, real estate is considered to go up in value, so it's an appreciating asset. I'm not going to get into those terms or terminology during this training, but I do want you to understand what a mortgage is, what an interest rate is, and what term is. Term, again, is length of time. Interest is the price you pay to borrow money or the cost you charge to lend money. Interest is most often reflected as an annual percentage of the amount of a loan. This percentage is known as the interest rate of a loan, or APR, which is annual percentage rate. Now, your term is the management of large amounts of money, especially by governments or large companies, and provides funding for personal and enterprise. The term can have multiple meanings based on the context. It can refer to the time period of an investment, provisions of the agreement, which again, we just went over that. There's the provisions of the agreement, and then also this is the term, and lifespan assigned to an asset or liability. The term or maturity of a product can play a significant role in assessing a security's riskiness. So as you can see, the terms are a big deal. If we're calling about a property and the property is only worth $100,000 and their ask is 90, well, if we paid 90, that would only give us 10,000 of equity. Now, if we paid 90 but we borrowed 80, so we paid 10,000, then that we would then have 20,000 in equity. I hope that explains the difference between equity and debt. Now, our debt is the amount owed. So if we borrow from a bank or a lender, it doesn't matter who, if we owe money on that asset, that is considered a debt. Debt. Now, how much it costs us to have that debt is considered an interest rate, or APR, annual interest rate. And there's also at times things called points. And this is a APR paid at one time. So for instance, 2 points is actually 2% of the amount loaned. So if that's $100,000, that would be $2,000 to be paid up front when the loan is actually created. Now, a lot of times on banks, you don't see points, but there's something called origination fee or fees. And it's the exact same thing. It's a fee that the bank charges to originate the loan. Points are the exact same thing, except it's not going to be a bank type lender that's going to lend the money. Instead, it's going to be a private or another type of lender that would lend that money, and they would just charge points. So again, the big takeaway I need you to take away is your mortgage, your interest, and your term. And then understand that mortgages cost money to create. And then as well, if you're talking to a seller and they have a mortgage on the property, it is important to find out some of that information if you can, because we can do other things. Okay, there's things called creative finance, and we can actually take over or assume the existing mortgage. You can also do this thing called refinance the current mortgage. We can get a mortgage on top of the current mortgage. The seller can be a lender. So the seller can actually be a bank. And I'm just scratching the surface of what all we can do. And I don't need you to understand exactly what all we can do. I just need you to know about it and know that there is a such thing, so you're not caught off guard. Now let's talk about interest rate one more time before we close out. So interest rate, if I borrow $100,000 and someone charges me 12%, then after 12 months, I'm going to owe them $12,000. That's essentially $1,000 every month with 12% interest. But if I only keep this loan for 6 months, then I'm only paying interest on that term, or that timeline, which would be $6,000.